Yep, we're live. Okay, good, good. What's going on, everybody? I'm your man with a plan, Brandon Anthony Clark, joined by Deontay Blade Ford, Anthony Enriquez, and this is Thrive Wealth Solutions, and we are the top advisors there, and so we coming to bring to you some new strategies and some concepts that really are exclusive and unique to us. Um, if you guys have been following us for a while, we predominantly talk about cash value life insurance and how you can essentially use your cash flow to grow your expenses. I mean, not grow your expenses, grow your savings.
Yeah, we ain't trying to grow nobody's
Yeah,
expenses.
we ain't trying to grow those expenses, right? We try to grow our income, grow our savings,
Right.
and for a lot of us, create legacy.
Mhm.
Myself, especially myself included, man. I came into this industry, as a lot of really on the ground. Well, I like to say boots on the ground because there's a lot of hard work that went into you know coming into this industry, especially coming from like a corporate background. And so as I learn, as I grow, I want to share what I learn with other people who are willing to learn. And this space, this industry has given all of us on this call an opportunity to not just help ourselves, but help our community. And that's the bigger picture and the bigger focus of what we want to implement and talk about today. And so we got a couple people here live. These are what I want to say our very first guests to our new format. Now, if
Mhm.
you guys want to join us live, if you look right up to the in the corner here, all you have to do is text FLIP to 833-553-1614, and then you can be notified every time we go live and get exclusive access to actually join the Zoom webinar live with us here today.
Oh,
And
yes,
so
sir.
I hope you guys are ready and feel free. We are monitoring the chats on Instagram. We're monitoring the chats on YouTube, and we're monitoring the chats live here in the Zoom. Now,
And as you guys know, right, Instagram works on algorithms. So look, y'all beat me to the punch, man. Go ahead and hit that like button, run up the likes, because at the end of the day, the game is supposed to be sold and not told, but we giving you guys the info free. And ultimately is because, like Brandon said, our objective is to empower people. So if you're somebody that cares about being empowered financially, you want to be able to make your money work better for you, hit that like button, share this live, send it out to your friends and your family, tell them come join in, because ultimately we're giving you guys a new perspective on how to approach life insurance, why you get life insurance. This isn't a traditional life insurance conversation where we're selling you a death benefit. We're actually we're unlocking the superpower of life insurance for you in the way that people at the top of the food chain are using it. We're just making it simplified. So we brought you guys we got a really good presentation today that we've put together. That's going to give you guys a different perspective on how to go about approaching paying mortgages. If you are a mortgage holder, if you don't have a mortgage currently, and even if you're somebody that's renting, this is applicable to you as well. Because rent, you are paying a mortgage, you're just paying somebody else's mortgage. And so, yeah, get ready for that, guys. We bringing the heat today. We bringing the heat.
yeah, yeah, we bringing the heat. Hey, Clinton, feel free to like unmute yourself. As a matter of fact, before we get started, Clinton, since you're on the call today, is there anything specific that you want us to go more in detail with, man? So we definitely want to cater this to you.
Oh, I appreciate that, Brandon, and nice to meet you guys. Was it Anthony
and Deontay?
Deontay. Okay, cool.
Yes,
nice
sir.
to meet you guys. Yeah, definitely. I believe, like Deontay said earlier, I understand that the concepts. I just want to know more specifically about which product you guys are, which life insurance product, cash value that you guys are into, and what are the steps, basically. Get the breakdown.
Absolutely.
Okay. All right. So we will go into the actual product and spend some time talking about that. But we won't necessarily go into the company because there's a handful of companies that we can use, and we don't know exactly which one would be the best fit right off the top of our hand. That's a case by case basis, and we don't want you to think that we're prioritizing one company over another. One company is better. Because different companies are better for different people, and so that's why we kind of keep it general.
Right.
Got it. But we'll go into all those details for you. All right.
Got it.
As far as the steps and what it looks like, as far as understanding from point A to point Z how this works, you're definitely going to get that today.
Cool.
There we go. All right, so we're gonna go ahead and get started, man. Deontay, hey, so you guys watching, man, you guys gotta go follow the Wealth Mogul on Instagram, man. This guy be coming out with so many great posts, so informative, and we're lucky to have him here, working in this partnership with us here. Right now, I know you see my other guy right down below here, Anthony Enriquez. He don't talk a lot, but he has one of the hardest, most important jobs out of all three of us here, which is keeping everything moving on the back end. Right. So if myself, if I'm not the one reaching out to you, if it's not Deontay reaching out to you, it's gonna be Anthony. And he's just important as all of us here working today. All right.
For sure. Yeah. Teamwork makes the dream work. Y'all remember that. We all all set. You know what I'm saying? You're gonna go a lot farther with a team. But without further ado, man, let us get this presentation pulled up here. Go ahead and put a thumbs up in the chat for us real quick if you currently pay a mortgage, because this is gonna be even more I would say impactful. If you pay rent, this should be just as impactful, but the reality is that it's gonna hit home a little bit harder when you have a mortgage, because you've put yourself into a contractual obligation with that mortgage lender. So unlike somebody who's paying rent that can just discontinue paying rent, you're tied into a contract. So we're gonna show you how to be able to use your mortgage payment and have more power with it, right? Convert your cash flow into power for you. So let me go ahead and get this pulled up real quick. Let's see. Okay, yeah, that's it right there. Present.
All right, let's get it.
All right. Go ahead and give us a thumbs up when you can see the entire presentation on the screen. I know there's a bit of a delay on Instagram.
Right. Okay. Got it. All right, we get to go. All right.
Okay, cool. So to anybody who doesn't know what FLIP is, FLIP stands for Flexible Lifetime Interest Program. So what we're going to do today, we've catered this presentation specifically to homeowners and real estate investors. But once again, this is applicable to you if you pay rent as well. Okay. So this is powered to you by Thrive Wealth Solutions. And I won't take 100% credit for putting this presentation together, because the three people you see on the screen, we all played a role in putting this together. A meeting of the minds, we brainstormed and we put this together for you guys. So real estate investing. To any of the real estate investors on the call, if you're an investor where you own a portfolio of properties, you're somebody who does fix and flip, whatever the case may be, even for the people that are fixing and flipping, depending on your approach, I know certain people in that instance pay mortgage for a short duration of time while they're waiting for the properties to sell. But nevertheless, historically proven to be one of the best ways to build wealth in the United States, right? Property values are generally appreciating over durations of time. So you're seeing an increase in what your property's worth versus what you owe. Thus, a great way to build wealth. However, what we do know is that if you're somebody who, I think they said in 2020, that average equity appreciation on a property was about 16.4%, right? So you got this huge boost in equity or cash that's sitting inside of your home, but you can't access that unless it's through a refinance or selling your property. So if you sell your property, you can reap the profit. That's equity, right, that you're accessing. Or if you refinance and cash out equity in your property, that's an alternative. Home equity loans of credit, etc. Right? So we want to kind of address problems that exist with the traditional mortgage repayment, right? And we want to give you guys an alternative way of thinking when it comes to approaching your mortgage. So for everybody who has a mortgage right now, we know these three things to be very true. Mortgages are tremendously expensive. Even though the market is great right now, interest rates are historically as low as they've ever been in the last 2 years. In the last 2 years, as low as they've ever been previously, period, right? Yeah. Still, even in that instance, we're going to show you guys an example today of somebody who has a mortgage with a low interest rate, but the amount of interest that they would pay over the life of that loan. So we also know that the average homeowner is going to pay close to double of the purchase price of a property just based on the amount of interest that's going to accrue over the life of that loan, right? And like we've already, real estate is not really a super liquid asset, right? In contrast to an alternative that we're going to show you today. So, excuse me. So golden questions. These are questions we want everybody to kind of be thinking about throughout the duration of this presentation today. Keep these at the forefront of your mind. Are you looking to save more money? Well, we know that building wealth it's not just about how much money you make, but it's actually more about how much money you keep. So we should all be looking to save money, more money, but strategically. If you're not somebody that's interested in saving more money, this presentation is probably not for you. Not being rude, just being blunt, straightforward, right? If you're looking to be able to create a tax-free stream of income, find out strategical ways to get Uncle Sam out of your pocket and still be able to grow your wealth, this presentation is for you. If you are a mortgage holder and you're somebody that wants to figure out a way for you to be able to pay off your mortgage faster, here's the key part. Without making extra payments, this presentation is for you. Now, in your mind, you probably just went like, wait a minute, pay off my mortgage faster without making extra principal payments. Well, how am I going to do that? Sounds a little too good to be true, right? Wrong. We're going to show you guys what that looks like today, right? So for those of you who don't know what FLIP is, FLIP stands for, like I said, Flexible Lifetime Interest Program. Now, this is a new financial technology that's out of Silicon Valley, and it was created by Thrive Wealth Solutions, which is the firm that we're a part of. We are the TWS advisors, as you guys can see. So we're essentially the go-to experts when it comes to cash value life insurance. From here, I'm gonna go ahead and sip on my water, fall back, and let Brandon take the presentation from here, guys.
All right, cool, man. Cool, good stuff, right? So yeah, I want to talk a minute about FLIP and how this whole new technology came about. Like I said, we can't take credit for it because I'm gonna be honest, I'm not that smart. You know what I mean? And you're gonna exactly see why, like once you try to understand how this actually works, right? So I've been in the financial services space for 5 years now, and I've only done life insurance. Now, when I came into the industry, I kind of sold all the life insurance that almost everybody sells, which is going to be your term insurance, like what you'll get from AAA, what you'll get from work, what you'll get from State Farm, or maybe if your cousin or somebody sells life insurance. That's typically what you're going to get. I'm not knocking nobody or anything like that. It just kind of is what it is. I came into the industry from there, right? But as I got into the industry and I kind of learned, let's just say learn my way around. I always wanted to learn, like, what were things that I could do with my own money so that I could not have to work as hard, right? How many people don't want to work as hard as they're working right now?
Put a thumbs up in the chat if you want to stop or you want to reduce the amount of time that you're spending or exchanging for money. You want to make more money without giving away time.
Yep. You want to know something real interesting about rich people and poor people that they have in common?
Talk to us.
Rich people always want to make more money, and guess what? Poor people always want more money. So how can we? The difference is what we do with it, right? The difference is understanding money, how to circulate money, and how to actually use money. So a lot of times, what we're taught is to chase dollars, chase the green paper versus chasing value, right? We ain't gonna go off of that on a teaching moment because I think if you guys are already watching this right now, y'all already know what y'all need to do. You know what I'm saying? That's not really our job to like preach and tell you. But anyway, Flexible Lifetime Interest Program, FLIP, that's a new financial technology created in Silicon Valley, California, from advisors who have been in the industry for decades. So this is not something that is like new. This is just something that we're just becoming aware of. And there's a difference between that. All right.
It's been reserved for a small group of people.
Reserved for a very small group of people. So Clinton, you had asked earlier, what was the question? It was about the insurance specifically, if I remember correctly.
Yeah, I'm still here. I asked several questions. I mean, one about the guaranteed interest that you would get on your money that you put in. How soon can you take it out? Things of that nature.
Okay, all right. So we're gonna address those more on the back end because I think you have a pretty solid idea of kind of how it works. Right. We're gonna slow down for those of us who weren't fortunate enough to join us today. But we are gonna talk about that because there's gonna be a lot of questions, and your questions are gonna be the same as I'm assuming
the majority of the audience.
Right. Exactly. So if you
I
go
mean,
ahead and hit that next slide for me.
absolutely.
Oh wait, and let me I got you pinned up here. Oh, let me switch the view.
They should be able to see it now. I'm seeing it
Okay. All right.
on my Zoom. I'm not seeing it on Instagram yet.
You got it.
I'm still sharing my screen though.
Yeah, you good. I had
There it
you
goes.
because you were talking, and so your face was still up there. All right, so we good to go?
You had everybody just looking at
Yeah.
me? Man,
Yeah, everybody was just looking at you, man. I hope you wasn't doing nothing you wasn't
I
supposed
was
to
just
do.
drinking water. You know what I'm saying? I don't know if it was entertaining watching me, quench my thirst, but
All
hey.
right. All right. Luckily, it's a small screen on IG. All right. But anyway, so how does Flip work? So Flip is just a fancy way of saying cash value life insurance.
Right.
And this is a system that we are going to implement to take advantage of differences in interest rates. Why are a lot of people refinancing their homes now?
Because the interest rate has been reduced
The
significantly.
interest rate is reduced, right? And so interest is the amount of money that
Low interest rates.
Low interest rates. Yep, exactly right. So if I can go from a 4% interest rate on my home down to a 2% interest rate, then I actually get to save some money, right?
A whole lot of money.
A whole lot of money.
Depending on the length of that mortgage.
Exactly. So we're taking the same idea, the same logic that you would use in refinancing a house and applying that to a properly designed, actually a specially designed life insurance contract where we're going to take advantage of the difference in interest rates. All right. So what you're going to see at the top here is that when our premium or when our money, when we pay a premium, is going to go in this contract and it's going to earn an interest credit. Roughly, that interest credit is going to average 7%. Now, how are we getting that 7% credit? That's through a special life insurance contract called an IUL. It's called Indexed Universal Life. All right. Now, there are hundreds of almost every life insurance company out there that's a good one has an Indexed Universal Life product. It's
Right.
not necessarily having an IUL, it's having the IUL with the right capability. It's like a car.
Right.
All cars operate the same. They have an engine, they have a steering wheel, they got brakes,
Transmission.
they got all the same parts. But as we know, different cars have different features, right? Insurance is no different. So it's very important that you're working with an expert, somebody who understands the components and the mechanics of an insurance contract so they can design something like this for you. All right. So we're using an IUL. So the IUL, the way it works, to keep it simple, because we're not working with a whole bunch of time because we still got a long way to go today. They have a cap rate and they have a floor rate. Typically, that cap rate is 10%. The guarantee or the floor is 0%.
Right.
So all that means is if, let's say I put money in and the market does, here, let me erase this. All right, so let's say that your money is over here, and let's say the market, and I'm saying stock market is over here. They're going to use the stock market as a measuring stick to determine how much interest they're going to credit your account. So if the market does 10%, they're going to credit your account 10%.
Mm-hmm.
If the market does negative 10%, they're going to credit you 0%, which means you keep your money. But let's say if the market does like 20%, then because we're capped at 10, you get 10. So we got a pretty safe, pretty conservative, predictable way to earn a 7% return because this is based off of a 100-year stock market average, the S&P 500 to be exact. All right. So we're going to pay that premium into this insurance contract. And then once we pay that premium, the money is going to come back out of this contract as a loan, which costs roughly 4%. So if I pay a premium at 7% and then I take a loan for 4%, that difference is going to stay in my account and continue to compound. Does that make sense, you guys? Put a thumbs up in the comments if that makes sense. All right, good stuff. All right, so we're going to get ready to go into an example really quickly here. And we're going to show you pretty much what we set up for one of our clients. This is for, did we put their names in here? I want to say we did put their names. But they got really, really common names. So you might know them, you might not know them. Or maybe you know some people with the same names. All right, so let me pull this up. All right, so we're gonna look at Eric's plan first.
Yeah, we didn't even get. It's a couple more slides too.
Oh, there's a couple more slides.
Go back.
Oh, let's go back.
You moving too quick.
I'm moving fast. All right, my bad.
Moving quick. No, you're good. So,
all right, go ahead. I'm gonna let you finish that up, and I'll do the illustration.
Nah, you all good. So we just gonna kind of give you guys a visual, so that way you can. This is Flip. This is a general synopsis of Flip, right? So money's going in, earning 7. Money's coming out in the form of a loan at 4. Difference stays in the account, continues to compound at 3%. Now, these are clients that we're working with currently. Right, let me go ahead and example from our clients. So Eric and Ashley Johnson, they just started their mortgage in June of 2021. The financed amount on Eric and Ashley's mortgage was $425K. They had an interest rate of 3.25%. Their monthly mortgage payment, we are rounding, but it's essentially right at $2,400. For the sake of the illustration and the numbers, it's easier to give you guys solid figures. All right. So what we want you to really be attentive to here is, yes, the loan amount is $425,000, right? But at a 3.25% interest rate, if they were to do what most people traditionally do, which is take the full 30-year duration to pay the mortgage, right? Over that time span, they're actually going to end up spending, go ahead and circle that for me in red, Brandon. And actually, as a matter of fact, it's right to the left. You guys you don't got to circle it. So interest paid over the life of the loan is a little under $241,000. So if you take up that $241,000 of interest plus $425 as a finance amount, they're paying close to, let me see here, $666,000. Now, what you see here in the bottom right, that's illustrating that $666 plus taxes and homeowners insurance over the duration of that loan, right? So now let's think about this. So for them specifically, what this looks like, and Brandon's getting ready to show you guys an illustration actually showing numbers, but they have a $2,400 mortgage payment. So in this flip contract, right, in this specially designed index universal life insurance policy, they're going to flow $2,400 into the flip policy, right? Now, when the money goes in, it's going to earn an average of 7%. But then they're also going to take a loan out to be able to cover that monthly mortgage expense at a cost of 4%. Now, there's an interest arbitrage on average of 3% earned on the monthly mortgage. So that's $72 a month of tax-free money, right, that your mortgage payment is now generating. So you've turned your mortgage payment, which is an expense still, into income for you. Because let's understand this, for everybody that has a mortgage payments are very interest heavy the first 15 years of the mortgage. So not only are you paying a mortgage payment that's heavy in interest, but when you're paying that mortgage and you're building up equity, it's great that you're building up equity, but once again, that's not equity that's easily just accessible. You have to meet lenders' guidelines and regulations on credit score, income level, debt to income ratio, loan to value, all of these different factors in order to be able to go in and access that equity. So we're showing you guys something today that's going to allow you to counteract, right, the interest that you pay over the life of the loan by flowing it through flip. The amount of money that you're going to make tax-free is going to be far greater than what you're going to pay in projected interest over the life of the loan. And we're going to show you that. And that gives you 2 options: pay off your mortgage faster, or just take the full 30-year duration, but by flowing it through this, you're gonna earn much greater than what you owe. Okay. So at this point, I think you can go ahead and pull that up.
Okay. And then we'll circle back because I want to talk a little bit of, there's a couple other things that we're gonna talk about as well. So let's see what we got here. All right, so we're gonna look at Eric's policy first, because we did do one on the husband and the wife, and I'll tell you why we're doing one on the husband and the wife. Okay, we didn't put their income here, but they had a pretty solid income. Like combined household income was $100,000 a year after taxes, right? So, and they had one kid, so pretty let's say stable, like let's say financially, right? So, what you're taking a look at right here, and let's wait a minute, make sure that it's big enough on on the screens here. Okay. All right. Is it big enough on?
I'm waiting for it to load up right now. Let me see.
Okay.
Uh,
make it bigger, huh?
You could probably zoom in a little bit.
Okay, this is what we'll do.
We appreciate y'all working with us. You know, we putting it all together, but we trying to get very surgical with our presentation, so that way you know you guys are getting top-notch quality tier information that's easy to understand, streamlined processes. You know what I'm saying?
Yep.
So
there we go.
Okay, I see what you
did. How was that?
Move that $2,400 mortgage over because you're covering the age. Top left yellow box.
Oh yeah.
I'd say just put it next to the 36K on the right-hand side and explain it.
Oh, okay. I got you. Right there. Good. And then we'll expand this just a little bit more because I think that yearly savings column is very, very critical to understand.
Absolutely. Put a thumbs up in the chat if you guys are understanding so far the presentation, if it's just kind of making sense in terms of what we brought forward so far. Put a thumbs up in the chat. And if you have any questions, feel free to put that in the chat as well.
You know what, we'll cover. We'll the death benefit is kind of like, oh, by the way, nobody's buying this for insurance, so we'll do it this way. Yeah. All right.
Yeah, y'all heard.
Y'all heard me right. All right. So
we're not selling y'all. Now we have insurance licenses, so we are a death benefit in itself is still a necessary asset to have, but we're not selling you insurance for a death benefit. We're selling you insurance, or we're teaching you about insurance for the other advantages that it contains.
Yes, living benefit, namely, right? All right. So what you are looking at is an illustration. All the illustration means is we're going to show you how much money is going in the policy or contract, how much money is coming out of the contract, and showing you a projected return or interest credits over the lifetime of the contract. Mm-hmm. Now, all these are hypothetical numbers. These are all based on 100-year averages, all right? And so what you see here on the far left, let me just get my pen out. You have the year column. So this is going to show us years 1 through the lifetime of the contract. Second section you have is the age, right? So Eric is 35. His insurance age is actually 36. I don't know why I told you guys that, but you'll learn once we sit down that you have an insurance age and a real age. Uh-oh. All right. So now the next column that you see here is the actual premium that is going into the contract. Now the premium, these are all annual numbers. So what I did was we took their $2,400 mortgage payment plus $600 of savings that they're already saving, right? So if you guys aren't saving any money, you definitely want to start. I'm just kidding. Sure. All right. So what they're going to do is they're going to pay that as a premium. So that's a total of $3,000 a month. Now, why is Eric choosing to save $600 a month inside of this contract as opposed to inside of a bank account or inside of a Roth or inside of a 401k or inside of any other asset?
Let's see.
You guys have any clues, Clinton? Do you have any idea of why he may want to save $600 a month there as opposed to somewhere else?
Because the interest gained on it is going to be tax free.
Here we go. Tax free. Tax free. And we're talking roughly a 7% average return as opposed to, let's say, a savings account with a roughly 0.04% average, right? Yeah. So we're going to treat this also as an emergency fund, like a buffer, all right? So the next column where it says loan costs, so that's money coming out, and that cost is going to be roughly 4%. So if you look down here, I put a note. $2,400 mortgage payment comes out as a loan. That's going to cost roughly 4%. So to recap, Eric's paying $3,000 a month as a premium to his F.L.I.P contract, and then he's taking out $2,400 a month for his mortgage payment. Got it? So what that means is he saved $600 for that month. Over the course of a year, that's $7,200 total. Got it? That makes sense, Clinton?
Yeah.
All right. Now, that's per year. Now, if we look at the lifetime savings, this is just going to add up how much he saved every year. So if you notice in year one, he saved $7,200 total. But if he did the same thing he did in year one, or in year two that he did in year one, then that would be $14,400 that he would have saved total. Got it? All right.
Yep.
The cash value column, this is a very important column. This is how much money that is left in the line of credit or the savings account that we use. All right. So to recap, Eric puts in $36,000 of his money, pulls out $28,800. He kept $7,200 in the policy for that year. Of the $7,200 he put in the policy or left in the policy, there's still about $4,500 that he could still use from that account. Now, the reason why he can't take it all out is because there has to be some money in the account to cover the cost of insurance for that. There's a little bit over $500,000 death benefit, which covers his what? What is that going to cover if something happens to him? Well, you guys want to help me out? What did he?
I got you, but I want to see if Clinton got an answer.
Okay.
I mean, it can cover whatever it do. It can pay for the house.
There we go. Exactly. Yep, that's exactly right. So we're covering his mortgage by using his mortgage payment. Is what I wanted you guys to take hold of.
So let me just stop and make a key point right there, right? For everybody who has a mortgage, if you have a mortgage to the FHA, you pay mortgage insurance protection. If you have a conventional mortgage, you're paying private mortgage insurance. Either way, right? When you pay that insurance, that money that you're paying, and this is especially for people, this particular individual, we didn't include that in here, but just understand this, right? You're paying that insurance, but really the insurance is covering the institution that's lending you money in the event that you were ever to foreclose or not pay them back. So we don't really, around here, we don't really consider that mortgage insurance. We understand that that's the professional, technical, financial term for that, but you're insuring an asset. You're paying for insurance for the bank or for the lender. They're requiring that you pay that because they want you to protect their asset until you earn it. So we're showing you how to make money off an asset you don't yet technically own.
There you go. Ooh, man, say that again.
We're showing you how. Go ahead.
I said that's deep.
I mean, you know, we don't want to go too deep because, man, this stuff the water gets so deep we can drown, right? but right, that's their cushion if you slip up, exactly. And so, ultimately, we're showing you how to create a cushion so you can't slip up because, unfortunately, foreclosures, forbearance, these are common issues that many people or especially people right now during the pandemic-based economy are experiencing. So we're putting power back in your hands as the consumer through a process called F.L.I.P.
Yep, there you go. Hey, real quick, Ant, need a favor, man.
What's up?
Jared is actually watching, and I saw that he registered, but he registered using the old link, and he's in the waiting room for like a different room. If you could just copy and paste the ID in the chat here, and then once they pop up, go ahead, let them in. All right, and I guess that goes for everybody else watching right now as well. And when it's live, come join us live.
And one key point that I want to also point out that's not illustrated here, right, is so you're looking at an illustration that shows $36K coming in and $28,000 coming out. But understand that $28,000 is not your money that you just put in there. So you put in $36,000 annually. You borrowed $28,800. Now, right now, traditionally, we all know the answer to this. Put it in the chat. Who do we usually borrow money from? What's the name of that institution?
Wells Fargo State Employee Credit Union. It must not go on.
Yeah. So these are what we call what? Banks and credit unions.
Banks, credit unions.
Put a thumbs up in the chat if you knew that you could borrow money from insurance companies. the same way that you do like a bank.
The right one, written the right way.
Absolutely. You won't find that anywhere else but here. You know what I'm saying? With the TWS advisors team, because now look, simple and plain, we bringing you guys some magical information. So understand that we're showing you, we're not telling you get rid of the bank. You can still keep your bank account, right? You actually need your bank account, right? But we're showing you how to implement an additional step, right? So that way you make money off your money.
There we go. Absolutely. Absolutely. Now, quick recap. Eric's paying $3,600 or $3,000 a month as a premium. That's his $2,400 mortgage payment plus $600 of money that he already saved. Mm-hmm. From there, he's going to take a loan and borrow $2,400 to pay his mortgage, keeping a total of $7,200 in for the year. And he's going to do that each year for 10 years. And that's what you see reflected in that column. All right. So over a 10-year time period, if Eric Johnson saves $7,200 a year, that's a total of $72,000 in savings that he would have contributed. Let's take a look at his cash value at that point in time, right next to it. All right. So Eric has saved $72,000. The $72,000 that he saved has now increased in value to be worth $93,665, which is roughly a $21,000 tax-free gain on money that he was saving.
And it's key to understand that that's money he would have not made. I want to stress that all the time. That's
money he would have not made.
That is money that would have not been made, because right now, if this is you're paying out $2,400 in a mortgage. All you're doing is building equity in your property that you can't even access unless you meet their rules. So we're showing you how to build equity and flip.
There we go. Now I also want to highlight something else. Let's take a look at that death benefit, because I know we don't talk about it a lot, but this is very, very important to understand, because as you grow, as this insurance contract grows, so does your death benefit, which is huge if we're talking about transitioning and passing on a legacy, right? So we started with $538,000 of death benefit. Now that amount has increased over time. All right. So after this 10-year mark, we're telling Eric, look, you got enough money in this account, man. You got $93,000 in here. You don't need to save any more money in here. All right. So Clinton, I want you to help me out on this next portion right here. And I want to see if you can help me read this out. So you see down here at age 46, right here.
Where? Let me see. Yeah.
All right. So at 46, how much money is Eric paying as a premium for that year? That's going to be in this column. Matter of fact, let's come down here.
That 333, 530.
Wait, where are we at? Let me see where you at here.
Hold up, make sure we.
You're looking at year 20.
You're looking at year 20. Yeah, come all the way up here. You see year 11, age 46.
So what we go up one more line.
One more line. Right there.
No, one more. Right there. Okay.
So fully
funded. Go ahead.
It says the account is fully funded.
Yep. Account is now fully funded.
So what do you notice that's changed? In the first two rows.
Yep. This row right here. How much? You remember this is our premium row.
Yeah.
So Eric is still paying his premium of $36,000 a year or $3,000 a month. This is our loan row. How much is Eric taking out?
Oh, 36.
So how much is he saving for that year?
Zero.
All right. How about the next year when Eric is 47?
Zero.
So from year 11 all the way down here through year 20. And I want to pause on year 20 for a reason. We're going to probably pop back over to the other slide. But at year 20, after 20 years of paying this mortgage, right, After only saving $72,000, which was saved in the first 10 years of his contract, let's take a look at the value of Eric's account at that point. You see that there, Clinton?
Yeah.
Eric now got $333,530 of tax-free money that he could use however he see fit.
So let me highlight that. So you
So he
saved
can pay it off if he wants to.
So you saved, exactly. Say that again for us real quick.
I said, if he so desires, he could pay it off, the mortgage.
Exactly. And then at that point, let's just say that would be a point in time when Eric and Ashley are going to come sit back down with me, Brandon, and Anthony and explore what their alternatives are now that they have all this equity in their home, or now that they have a home that's fully paid off, an asset that if they wanted to liquidate and use, it's a possibility, right? But $72,000 made Eric and Ashley $333,000, right? That's a $261,000 profit gain of tax-free income. So Uncle Sam isn't touching any of that money, right? Now, what we want to do is we want to contrast that, right, at over a 20-year duration in their mortgage. How much? Now, we're not even going to show you a 20-year duration. What we're going to show you is over the 30-year duration in their mortgage right now, that 30-year mortgage, how much projected interest that they would have paid. And we already showed you guys. Does anybody remember?
Does anybody remember? Go ahead, throw it in the comments if you remember, or in the chat.
It was like 200 and something, I believe. What was that?
No, how much interest were they going to pay on their mortgage prior to utilizing F.L.I.P? That's the question.
Yeah, it was like 200 and something, I believe.
Absolutely. So the amount was $241,000.
Yeah, I remember that. Yeah.
So let's say they just went through the full 30-year duration and paid their regularly scheduled mortgage payment as it amortized. It would become more principal heavy. They pay it off, right? By the end of year 30, they would have paid $240 in interest, but 20 years into their F.L.I.P plan, they are already in the profit, right? The difference, they have $333,000 of cash value. If they wanted to just say, okay, you know what, at year 20, let's go ahead and pay off the remaining balance on that mortgage. That's optional, like you said, Clinton. Or we can go down 10 more years, right? Which at year 30, they now have a cash value of how much?
$1 million.
There you go.
So
now, what are we going to do with that?
$100,000 profit roughly by just saying, hey, before I give my money to any of whoever I have a mortgage loan through, I'm going to stop it. I'm going to do a pit stop and put it in here and then take it out of this.
There you go. There you go. Now from this point, I want you guys to notice something here. From year 11 all the way down here to year 30, right? All those zeros. Because how much was Eric saving? He was saving $7,200 a year, right?
Right.
All right. So my question becomes to you, and I'm gonna ask Clinton again because you was here first, and I can't see anybody else. So I know you in here. Ask you this question. So, Clinton, if you had an account that paid you 3% of every dollar that you flowed through it, would you ever stop putting money through it?
No.
Never. Correct.
Never.
So we wouldn't want to stop putting money through here. Now, just because we stopped having Eric save $7,200 a year in this account doesn't mean Eric wasn't saving money somewhere else. You guys follow what I'm saying?
A different cash value?
Either another insurance policy or another asset, whether that be a Roth, whether it be real estate, whether it be crypto, whether it be anything.
Paying directly into a mutual fund, an ETF, whatever the case may be.
There you go.
Even real estate investing.
There you go.
Gotcha.
And so what's going to happen is now Eric is taking the $7,200 before he invested wherever else he's going to invest it. He's putting it here so that over his lifetime, he's going to create another account that is going to grow for him. Once Eric is ready to retire, he's going to start taking distributions from his policy, or not from his policy, from his other accounts. But before he spends that money, he's going to flow that money through here first.
I don't think they're ready for what they're about to see, Brandon.
All right, so what you see here, oh, they really ain't ready because we ain't even halfway done yet. We ain't even halfway done.
Uh-oh.
All right, so now what we're doing is you see that in this policy, Eric is still paying premiums. So that $30,000 a year is coming from his other investments that he set up, whether that's Social Security, whether it's pension income, whether it's dividend income from his stock portfolio, whether it's rental income, whatever it is, he's flowing it through here first. Right. Now, in this column, what you see is $180,000 coming out as a loan. Okay, so that's his 30 that he put in, plus an additional $150,000 of tax-free income being distributed from this account. All right. Now, what we're showing here is Eric taking out that additional $150 a year for a total of $180 from age 65 all the way down here through age, I ran it through age 100. So assuming people are living longer these days.
This is a bomb though, guys. You guys got to really understand this. There's not a lot of people pulling in $180,000 of tax-free income.
Yeah. Matter of fact, it's a tax-exempt income. There isn't even a tax form to put this on.
So we're talking about somebody who, at any point, he did not ever contribute anywhere near this much money to the policy on an annual basis. The most he put in every year was $36K. Then it converted over to 30. In 10 years, he saved $72,000. And that just from the eighth wonder of the world called compound interest.
Compound interest.
He was able, with that savings, to generate a lifetime stream of income, of tax-free, tax-exempt income at $180K annually. And this is all through this. Remember, this is all just through the power of funneling a mortgage payment. We all are paying rent and mortgage.
Yeah.
So here's a question, Clinton. If we're all paying rent and mortgage, is there any reason why somebody wouldn't utilize something like this?
Stubbornness, I guess. Yeah. That'd be the only reason that I could see.
Really, we normally get disbelief from most people.
Yeah.
Yeah. That sounds way too good to be true. What's the catch?
Yeah.
The catch is you got to qualify.
And I see that.
And that's the question. What would stop a person from being able to qualify?
There's a number of things. The biggest reason we see people not qualifying is health. That's the biggest reason, because it is insurance. So you do have to qualify for the insurance aspect of the contract. So that's the biggest wealth. The biggest quality. Exactly. Your health is tied to your wealth.
Absolutely. Right? What's the point of having a lot of money if you don't have a good quality of health?
There you go. Hey, and so
this should incentivize you.
Give us some examples of I got health. Give me some things that knock a person out. You've seen knock people out.
The number one reason is BMI, the body mass index, height and weight ratio. Meaning
that's cool.
They're overweight. That's the number one reason for most people either getting declined or having to pay a higher cost of insurance. Right. So we don't want to. Typically, we can still make it work, but we always advise people before we even implement the system. Like, look, the goal is, even if we set it up today, you have a rating, and what all a rating means is you're below a standard rating. So just like you have a credit score, the higher your credit score, the better rating. Insurance companies have the same type of profile that they go based off of. So the better your health, the cheaper the cost of the money that you're buying, because essentially you're buying money at the end of the day. So if we notice,
and that seems so controversial of a statement, but understand that that's mathematically substantiated. We're not just throwing that out there. I mean, these numbers show you that right now.
You're buying money. Yep.
But also what I found kind of amazing is, because traditionally, you don't see death benefits going up like that. That kind of threw me. I'm like, well, the death benefits, going up. And so generally, they pretty much either stay the same or go down, or the premiums go up so high that people have to let it go. So that right there was outstanding to me. This kind of stood out.
Yeah, most, and the reason for that is most policies that we see designed, most typically people will buy them for death benefit,
right?
Buy a level death benefit. And so what they'll try to do is pay the least amount of money, and then they'll try to buy the most insurance. But what's something that you notice in this contract? Eric's paying $36,000 a year, but his death benefit is only $538,000. can we all agree, just kind of based on like common sense, that he could probably get a lot more life insurance if he wanted to?
Absolutely. I mean,
Oh
let's
yeah,
put
yeah,
it
Yeah.
in perspective. The
yeah, for
average
sure.
a 30-year-old non-tobacco user, male, average 30-year term for 500K of insurance might be $50. I mean, $50 a month. So for you to be paying $50 a month and getting 500K of insurance in a term policy, you're putting $36,000 here into a permanent policy and only getting $538,000 of coverage. So that's a
I
part
got
of
you.
the special design that we do here, as far as how we operate with the F.L.I.P concept.
Exactly. And so we're only halfway done because I haven't showed you guys Ashley's policy, right? I still got to show you guys Ashley's policy. And so real quick, I'm gonna pull that up. And because we gotta technically we gotta put one on Ashley too. And I'm gonna tell you why we gotta put one on Ashley, but I want to make sure this is big enough for you guys to see. Of course.
And Ashley is the wife.
The wife. So she's a couple years younger. So her numbers are gonna be a little bit different. Let's see if I can squeeze these down.
And I see that a couple of other people joined the room. Welcome, you guys. We appreciate you attending. If you have any questions at all, go ahead and unmute your mic and ask. Feel free.
All right. All right. Is that big enough for IG?
Yeah.
We got a little delay. Good. Okay. All right. Cool. All right. So same thing for Ashley. We got a premium of $36,000 that's going in, which is $2,400 mortgage payment plus $600 of savings. And they're going to take out the $2,400 mortgage payment from this side as a loan. But my question to everybody is, how? We were paying $36,000 a year for Eric's policy, but then we're also paying $36,000 a year for Ashley's policy. That's a total of $72,000 a year. And they only make, how much was it, like 100,000?
It was a little under 100K net.
Yep. So my question is, how are they paying $72,000 a year for 2 life insurance policies when they only make a little under 100,000?
Just so everybody know, this is about to be the mic drop. We already hit y'all like with 4 of them, but this one about to be the biggest, the kaboom,
Well, are they flowing other bills through there or not?
I like the word flow.
I like the way you're thinking. You close.
Like the way you're thinking. You warm. Germs.86 said double dip. You're gonna have to unpack that or hop into Zoom so you can, you can explain that verbally.
Germs know what's going on. He know what's going on.
Okay.
You know what's going on. I showed this to Germs.
Okay, so we like the comments. I need to get in on this. We got you, Mr. Light.
There we go.
They flowing their money. That was one of the answers in the chat.
Yep. So check it out. It's the same $2,400 mortgage payment. So what's happening is they're paying the $3,000 into Eric's policy, taking out $2,400, passing that through Ashley's policy. Ashley is adding her own savings because I know typically that's how I work in my house. I got my money, my wife got her money. We keep our personal savings separate, right? We got money together, but we keep some money separate. And so she's building up her own account using the same mortgage payment. How about that?
Can we go to year 20 for him?
Yeah, let's just go to year 20 for him. And her policy is the same way. After 10 years, she's fully funded. She's not going to save another dime in the policy. And just like Eric, this is where it gets good. Check out what we're going to do.
You got to go to year 20 for him real quick. I got to make this point.
Oh, year 20. My bad. I kind of went way too far. They be like, wait a minute, what happened?
So quick question. So everybody remembers that in Eric's policy, right, the cash value that was built up there was essentially the equivalent, a couple dollar difference, right? But also by flowing the money through this policy, what's the cash value in this one?
Almost the same.
Yeah.
So if we go to year 30 real quick.
Hey, so let's check it out though. So that's now 2 accounts.
Yeah, I'm getting there. Let's go to year 30 real quick.
Okay.
So remember, In the other policy, they had over $1 million of cash value in just Eric's policy alone, but their total projected interest paid on their mortgage was $241,000. So they're already close to up $750K profit. But in year 30, by doing a double flow right through this policy, she has another close to $1.1 million. So did they really make $750 in profit, or did they actually make about 1.8 in profit?
Yeah.
Here we go. And this is where we get good, because now we're talking about retiring. Okay. Now that you guys understand the flow, how you can use these and flow money through it. How much were we taking out of Eric's policy? You guys remember that number of income we were taking out from Eric's? We were taking 30,000 of his other income plus
his assets that are liquidated. We was flowing that through the policy and taking out how much after we put the 30K in.
Matter of fact, I'll just go back to it so they can see.
Yeah,
all right.
We want them to have that visual.
All right. So $180,000 a year of income is coming from Eric's policy.
Yeah.
But before we spend that, guess what we're gonna do with it? We're gonna flow it through Ashley's policy. So now you see 180,000 coming in from Eric's policy into Ashley's policy, and now we're taking out 360 total. So that's their total retirement income, 360,000 a year, and we're running that all the way from 64, and we ran it through her age 100. All right, and I want to.
So how much did they save in the policy in total?
Total, they saved $72,000 a year, or total in two policies. So a total of 144 grand was saved throughout a 10-year time period for both of them.
So 144,000 in 30 years turned to $2 million.
Actually, it turned into a lot more. That's why I want to highlight this lifetime savings column. All right. So they saved 72,000 total over the course of that 10 years. Now let's look at the withdrawals coming out. In the very first year of retirement, they take out 180,000, which means they got their original 72,000 back plus $108,000 additional.
Right.
All right. Next year they take out another 180 from this one. Now they're at 288, and so forth and so forth. So assuming Ashley lived to age 100, she would have received a total of $6.5 million in tax-free income, and she would be leaving behind a $15 million tax-free inheritance that will go on to her legacy, on top of what we ain't even showed you Eric's death benefit, but it's roughly the same. It's
so $30 million of tax-free generational wealth passed on.
Yeah. So this is how you use an insurance contract.
Exactly.
To bank with. This is how you do it. This is universal banking with F.L.I.P. We're the only people doing this. Not us three. There's like maybe 2 or 3 dozen people in the United States who do this. We just happen to be on social media more than everyone else.
Right.
But we got a team of people who are dedicated and can help you put something like this in place for you and for your family.
So right now the system flow, if anybody wants more information, you guys want to sit down with us on a one-on-one basis, first and foremost, come to the classes. If this is your first class, we definitely want you to come, one more time, just to check us out. Make sure you fully grasp and understand the concept. And if you feel like this is something that's important for you to implement, you're serious about it, click the link in Brandon's bio, fill out the registration information there and book an appointment to speak with us. Absolutely.
Yeah. And so to kind of just go over qualifications, kind of how we operate, we want to help everybody. We like to help everybody. But something like this takes a lot of time and a lot of planning to go through. Like typically before any transactions happen, there's roughly a 4 to 6 week process in order to even implement something like this on average. All right. We already got tons of people pretty much on a waiting list right now. So we can always add you on the waiting list, and we're happy to do that for free. Like that's free. And right now that waiting list is about 3 or 4 weeks long. But then we also have a separate list. So a separate list, there's a charge for that. And the only reason for it is, like I said, there's a lot of people who are waiting, and there's a lot
that goes into servicing.
There's a lot that goes into servicing. And the way we're actually able to implement this design for everyone is we take a lot almost all of our commissions are come out of this contract. Because how many people have seen an insurance policy where you could take money out of it in the first month? How many people have seen that?
Yes, Mr. Johnson, to answer your question.
Mm-hmm. Yep. That's because there's three parties in this insurance contract. You have the insurance company, who we all know they're not going to miss out on any money. They are a financial institution. They're in the money-making business. The second person we got is the insured. That's the person paying the premium. And the third person is going to be your advisor who is helping you set up the policy, right? So those are three people in one pot, all right? Insurance company's not missing no money, so it comes down to either us or you. So who do you guys think deserves the benefit more, you or us? That's an open question for you guys.
The one paying the money.
The one paying the money, right? So what we do is we take a lot of our commissions out, so that way you have access to your money in the very first month, depending on how you fund it, because the majority of times we can get it out in the first month if you're working with, let's say, a lump sum. If you're like me, when I first started, I didn't have a lump sum of money to just kind of pop in the policy, so I had to save for a few months before I could start like cash flowing like this. So everybody's different. And if you want to go on the wait list, we're more than happy to put you on that one. But if you want to kind of speed up the process, there's a one-time $96 charge, and we can send you the link so that you can get access to it. And also that's going to come with access to the Kajabi platform. And you're going to also get access to a live call that was done back in May, June. And you're actually going to see some people on there who might look a little bit familiar, as well as some other clients who had just happened to just pop on because we just kind of started doing these live calls. So you get to hear their stories, kind of how they're actually using the policies themselves. And then when we get in a one-on-one, we can show you returns. I show people my own personal, not all of my policies, you know what I'm saying? I ain't trying to have in all my business. But I do disclose that I'm actively doing this. This is not theory. This is not, this might work. No, this is something that not only I'm doing, but everybody on the call is doing, and everybody at our firm is doing and implementing in their own financial plans. So
to answer the question that was put in the chat by JBN.O, no. Now, there is a strategy that you can utilize, but as far as paying it directly with your credit card, no, you need a bank account. So let's say you're somebody who already utilizes your credit card to cover a lot of your expenses, and you got cashback features. Then this would be a great opportunity for you to funnel the money first through the insurance policy, still pay your expenses with your credit card, and then in the loan that you're taking out from the policy, pay the credit card. That's what that strategy would look like.
Yep.
And then as far as 1035 exchanges, let's just say we'll sit down with you on a one-on-one basis and determine the most effective way to go about that. That's an option, absolutely, though.
It is. Did you already address the question if one already has an IUL, can the existing IUL be converted into a flip? Did you answer that?
No, go ahead.
All right. Sometimes they can, sometimes they can't. It all depends on the current insurance contract that you have. If it allows us to construct it in a way to create flip through it. If not, what you can do is a 1035 exchange, which is essentially rolling over money from one insurance policy into a new insurance policy. But there could be some surrender charges in that. So that's why we would have to just meet with you, take a look at your policy and see if that is an option for you. If you've had the policy for less than, typically I would say 3 years is kind of like an average, then you probably won't really be able to roll money over. So we try to just salvage whatever we can, just based on that. So yeah, just reach out to us. We can do policy reviews, and you could always schedule a call. Just hop on the website and click the time to schedule a call. All right.
I'm getting my bio stuff situated, guys. So pretty soon we'll all be interconnected with one system, and you'll be able to click on anybody's profile. But we function as a unit anyway. So
yeah.
Everybody you should automatically, just if you guys want free content, you want to be able to be empowered financially, get some classes that'll kind of just break down the rules of money. Click the link in Brandon's bio, register, so that way we can get you guys the information that you need on a weekly basis.
Yeah, there we go. Now, do we have any questions from anybody who's actually in the Zoom today? Anything else that you guys got?
I got a question.
Yes, sir.
Yeah, so nice to be back. Thought y'all wasn't letting me in for coming to too many classes.
Oh nah, man. Yeah, nah, you see things have changed a little bit since you've been coming.
Yeah, things changed a lot. Yeah, I was sitting in the front in the seat, like, yeah, when they gonna let me in. Yeah, so you know me. I've been trying to spread this knowledge to my circle and stuff like that. And pretty much one question I need for myself and just to explain it to my friends again is just the question of when you're borrowing against your policy.
Mhm.
I know that the money isn't coming from necessarily your account. You're borrowing their money, like from their what was it? Not their investment account, but the 3-to-1 account. Can you tell me
General.
why? Yeah, the general account. Can you explain to me why, or help me better explain why they're allowing you to borrow their money from the general account and not making you use your own money?
To be
That's a great
keep
question.
it simple, it's really the same reason why it works out better for you to borrow their money than use your own. What happens when you withdraw money from the account and then spend it?
I'm making less interest on my money.
Same thing for the insurance company. So the way they account for the money in their portfolio, once that money leaves the account, that's less money they have to account for. So they would much rather have you pay the premium and then let you borrow cash that they cannot even use anyway, because that is reserved for the death benefit. See that
Okay.
insurance, the cost of insurance, like that's why I said earlier, you're buying money. Because if you buy an insurance policy, there's a charge for the insurance itself.
Right.
Got it? And so that is accounted for. That cost of the insurance right there, that's money that's sitting inside of the general account in cash that they can't use anyway because it's for the death.
Okay, just in case. Yeah.
Right?
And it costs money to liquidate
And
money.
it costs. And so how it actually works is they're going to collateralize your loan. So if you put in let's say 10 grand of your money and you want to borrow 10 grand, well, what's happening is your cash right there serves as the collateral. So they're not going to let you borrow more than what you put in. Also, the death benefit serves as collateral. So let's assume that you borrowed the 10,000 and then you just happen to die before you paid it back. Well, they're just going to deduct that $10,000 from the death benefit that they were going to pay your family anyway.
Okay.
See, it's like any other collateralized loan. Cars work that way. Houses work that way. You could even collateralize stocks.
Okay.
Cool. So, yep.
All right, yeah. So yeah, I got a new roommate who I live with in college, and he don't believe me, but he says it's too good to be true. So
yeah, that's exactly.
I'm trying to explain it to him.
Hey, more for us, man.
Yeah. So
hey, people don't believe you. Hey, that's on them. They only got one shot. We know what we're doing. Look, I wouldn't do nothing with my money that didn't make sense. Like I'm sure anybody else wouldn't do nothing crazy with their money that didn't make sense.
Yeah.
So it is what it is. So we could try to help speed up his learning curve a little bit, but we're not here to help change people's minds or convince nobody.
Yeah, I definitely feel you. Yeah.
Which is why we said we'll show you guys our policies. Because we could just show you the policy and
yeah.
Yeah, well, once I get my policy, I'll show him. That's what he said. Once I borrow again in that second month, then he gonna be like, I got him.
Well, what if it's too late? What if it's too late by then? Because stuff like good, once a lot of people get it, it's kind of too late. It's like Bitcoin.
Exactly.
I got in on that like a long time ago. Now I ain't trying to touch a Bitcoin.
I forgot the
I got some though, but I didn't use none of my money to pay for it. Let's put it that way.
Yeah.
But hey, I just want to go ahead and say, everybody have a good evening. I'm headed to this doctor. I'm about to come back, guys. So I will catch in with y'all later. But I would appreciate if everybody could, click the follow button on my profile. If you guys have any questions at all, I'm also here to function as a point of contact, just like Brandon, just like Anthony. You guys have a blessed night, though, man. Everybody stay safe.
Absolutely.
And financial literacy translates to financial power.
Absolutely, man. We may hop back on Friday, Saturday, man, and just kind of freestyle it. And talk finance, man. So y'all be on the lookout for that. Text FLIP to 833-553-1614 to be notified every time we go live. All right.
Absolutely.
All right.
All right, you guys. Anybody else in the Zoom room have any questions before we get out of here for today?
No, thank you.
Either way.
Okay.
Nope. Everybody good?
Yeah, we good. I'm out.
All right. So you guys will get an email, and I'll also drop a link down here in the chat which is how you can get on the VIP list where you can kind of just bypass the line. All right. So yeah, we'll just kind of go from there, and let me know if you guys need anything. All right. Thank you guys for coming through.
Yeah.
Later.